might say back then that the Bank of Canada is overshooting. They're raising interest rates way too much because inflation is a lagging indicator. Remember, we discussed that. And now the Bank of Canada is basically fixing it. Now, we have to realize that we are in a very weird period in the economic cycle. Just a few days ago, I had a meeting, a lunch meeting with some clients. And on the way, the elevator would ask me, do you have good news for us? And I said, well, it depends what you said for lunch. And then I was thinking about it, That's very important to communicate to clients. What is good news? If tomorrow I tell you that the job market, employment will rise by 200,000 jobs, very strong. If I tell you that tomorrow the economy will expand by 5%, very strong, is it good news or bad news? Well, it sounds wonderful. But for the Bank of Canada, it's a nightmare. Because they want to see the economy slowing down. So for them, it's a nightmare. So in a very twisted way, bad news is actually good news. Because if it's not happening, if the economy is not slowing, it means that they are losing their fight against inflation. And they don't want that, because then it means that they stop cutting interest rates. So bad news is good news. And if bad news is good news, I have plenty of good news for you. No, really, because the economy is slowing down, there is no question about it. And that's by design. The unemployment rate is rising by design. That's why you raise interest rates. I was sure that the Bank of Canada is overshooting back then, and clearly they were overshooting. Now they're cutting, and they're cutting very fast. We'll discuss why in a second. But clearly, a year ago, everybody was talking about inflation. And remember, we discussed it, and we said, it's never about inflation. It was never about inflation. It was always about the cost of bringing inflation down to 2%. So when you discuss inflation with clients, use that line. This is not about inflation. It was never about inflation. It was very clear that inflation would go down to 2%. The question is, what is the cost? And the cost was overshooting, raising interest rates way too much. Now inflation, not an issue whatsoever. In fact, if you measure it correctly, and again, we discussed last year, remember I told you that the way we measure inflation in Canada is very weird. It's, we're using rent, we're using commission to real estate agents, but the most important aspect is what? Mortgage interest payments. Now, forget about economics, think about it logically. The Bank of Canada is raising interest rates to fight inflation. Higher interest rates are adding to inflation through higher mortgage interest payments. You see how crazy it is? As I told you last time, it's like putting a humidifier and a dehumidifier in the same room, let them got each other. Doesn't make any sense. Now, if you remove mortgage interest payments out of the calculations, you know where inflation is? 1%. It's half the target. And another, by the way, the only other country in the universe that is using mortgage interest payments as part of the calculation, is Iceland. A major economic superpower. If you measure inflation the way the Americans measure, it will be 1.2%. We are already there. We are undershooting cut, and that's what we do.
Wow. Yeah, I get it. Because you're absolutely right. You know, your payments go up. A lot was because of interest rates.
Exactly. So they control it.
It makes
it doesn't make any sense.
Makes so much sense. So obviously, you know, we've had a number. I think we've had 4 cuts this year, 3.75. I suspect we'll have another one in December. In all fairness, right? Unless something really crazy happens. So as we move in, where do you think rates are going to get to? Because obviously the real estate market is directly affected by interest rates, right? And I'm not sure with this, you might know, but I think the only reason we've ever had real estate prices fall is because of interest rates.
Absolutely. And remember, interest rates went up for a reason. We were in an inflationary situation, and that was good. They were overshooting. It was very clear that they were overshooting. They were overshooting by design. Now they have to fix this overshooting and cut significantly. So we were lobbying for 50 basis points. Last meeting, we said, listen, guys, you have to cut. We were overshooting. They did. I am lobbying for another 50 basis points in December. We'll see. Maybe 25, maybe 50. It's 50 for 50. That's the way I call it. But the question is, and that's something that I'm sure that your clients are very interested in, where the Bank of Canada is going to end. What is the terminal rate? We call it the terminal rate, when you stop. And I think it's a reasonable guess now that it will be about 2.5. So we are 3.75, 2.5. That's more or less where we are. Now, the issue is that I want to see 2.25 because 2.5 is where you should be. Now, something very important to understand and again explain to our clients. There is something called the neutral rate of interest. Neutral, like in the car neutral, it's about 2.5. So as long as you are above 2.5, you're actually tightening monetary policy. It makes these things more difficult. So when you move from 5 to 4, you are still tightening, but you're tightening less. You're not stimulating. When it goes to below 2.5, you're starting to stimulate the economy. So when you cut from 5 to 3.75, you're not really adding more economic fuel. You're actually basically stimulating the economy much less. Therefore, you need to cut interest rates to below 2.5%, and that's what I'm pushing the Bank of Canada to do. But 2.5 is the neutral rate of interest, which is going to bring you to neutral. Namely, not accelerating, not decelerating, more or less where we need to be. Now, very important to communicate to your clients. We are talking about variable rate interest rate. We're talking about the Bank of Canada rate, we're talking about the prime rate. We're not talking about the 5-year. The 5-year is determined by the market. And the market is determined by what's happening in the US more than what's happening in Canada. So one of the reasons why our 5-year is relatively elevated is because what's happening in the US. So don't tell your clients the Bank of Canada is cutting from 4. It will not happen. We are seeing a normalization of the yield curve, the difference between long-term interest rates and short-term interest rates. Variable rates will not be higher than long-term interest rates. They will go back to normal. The motivation here is to bring long-term interest rates back to normal and to cut short-term interest rates. And that's more or less where we are. So where the 5-year rate will go from here, I think it's a bit too expensive. I think it's too high. I think it will go down by 20, 25 basis points, maybe 30 basis points, maybe 40, but not more than that.
That's interesting.
So don't expect the 5-year rate to go way below 4%. And tell it to your clients, 4.5 is a reasonable gain. Maybe 4.20, but not 3.5. Because remember, the 5-year rate, when I say it's determined by the market, it means that it's already forecasting what will happen. And the 5-year rate is already pricing in 2.5. And that's the reason why I want to see the Bank of Canada taking it to 2.25, because that will lower the 5-year rate because they're not anticipating it. You see, that's the game.
What do you see? Oh, that's really interesting. I didn't know that. What do you see for the real estate market in 2025? What Korea, Canadian Real Estate Association, is forecast, say 500,000 sales, with maybe a increase in prices by 3-4%, maybe 5%. Is that what you see as well?
Yeah, to an extent, but I think that 2025, at least the first half of 2025, will be a tale of two markets. Will be the low rise and the high rise.
Right.
And I'm not sugarcoating anything here because we shouldn't. We should call it as it is. The low rise segment of the market is fine.
Yeah.
It's doing well, wonderfully, and it will do even better with interest rates going down. The condo market, I had to say that, is frozen. It's basically it means that you will smile forever. This is the most significant test that this condo market has seen since 1991. And I'm not sugarcoating here because we shouldn't. We should call it as it is, even if it's tough. That's what clients appreciate. You hold their hands in the deep times. Is the following. The condo market is in a recessionary territory. We haven't seen something like this since 1991. What's happening is that investors, unfortunately, are out of the market. 81% of investors are in negative cash flow. That's the reality. And the reality also is that developers are not building. Pre-sale activity is zero. So inventories are rising, investors are not there, but interest rates are going down. we are accumulating pent-up demand. Those investors will be back. So in a way, what we are seeing now is a very short period of time, of maybe a year, in which the condo market is a buyer's market. You go to your clients and say, you want a condo, the next year is your time. That's the only time in which the condo market will be soft, and you will have a bargaining power. A year from now, a year and a half from now, the condos that are supposed to be built now will not be built. They should be ready a year and a half from now, they will not be ready because nobody's building now. Which means the demand will be there, interest rates will be lower, investors will be back, pent-up demand will be there, and there will be no supply. You don't have to be an economist to predict what will happen. So tell your clients, the next year we'll see a soft condo market. Take advantage of it, because after that it will be in the sky. It's not a forecast, it's given. It's given. The only question is, Mark, how long it will take? A year and a half, maybe less. And when you want to bet, never bet against the real estate market. Because the demand is always there. You know, population growth is still there, despite what the government is doing, and we can talk about it. But I'm telling you that the next year will be a golden opportunity to enter to the market. That's the way to approach the market, the clients about it.
Very good. You mentioned immigration. So right now, based on what you read, Canada has a systemic problem. We don't have enough based on how many people we have in this country. And it's been like this for a little while. So, you know, obviously, one of the reasons I think our market's been very, very strong is we just don't have enough homes to house all the people. And we've had, for a while, a number of years, over 1 million people sort of coming into the country every year. I know some permanent, some non-permanent. But the government now is going to cut back. So going into 2025 and 26, where the government's cut back in immigration, do you still foresee us having an overall housing shortage?
The short answer is absolutely yes. Listen, one of the reasons why the economy is slowing down is that we are not in a recession. I know that many of you are very disappointed because everybody promised you a recession. We didn't get one. Now, why we didn't get one? Because we are in a recession. We are in a per capita recession. Per capita, per person recession, down by 2.5%. So the only reason why we are not in an official recession is because of the fact that we got 1.2 million people into this country over the course of breakfast. Like, it's crazy. And the vast majority of them are not permanent residents, they are not permanent residents, they are foreign students and non-permanent workers. Now, when it comes to students, listen to this, that's very important, and I was very vocal about it. 25%, 1 out of 4 of those foreign students are not students, they never go to school. They are here to buy citizenship on a chip. Then you have those Mickey Mouse colleges. Really, North Toronto Advanced Mathematics Academy. Welcome. $45,000 you're in. Give me a break. 20% of foreign students are in food banks. This is not the way to run immigration policy. If you cannot house them, don't bring them. It's not fair to anybody. That's exactly what the government is doing. I was lobbying for that. I met with the immigration minister just the other day. We are talking about it. We are vetting the policy. Listen, they are cutting significantly, but there are a few things happening here. You want to change the number from non-permanent residents from 7% of the population to 5%. That's 850,000 people that have to leave. Now, Canada is not going to deport them. We don't have the will, and we don't have the capacity to do so. So it's not deporting, it's not the US. But what we are going to do, and that's extremely important to understand, we had every year 500,000 people coming from outside Canada. We're cutting it to 400. Now, what they are going to do, out of the 400, 40% of them will come from Canada. Then there will be non-permanent residents that will be converted to permanent residents. You see? So 400, but only 60% of them will come from outside Canada, 40% will come from inside Canada, and that's the way you remove or you shrink the pool of non-permanent residents. That's what the government is trying to do. If you do the math, population growth in Canada will still be about 1.5% So no, we are not going even to bend the affordability crisis that we have, and that's why we have all kinds of policies to provide incentives to developers to build more, and we have to build differently. Let me just ask you a simple question. You take a pilot from 50 years ago, and you ask them to fly a plane today. They will not know what to do, you know, all those buttons. You ask a construction worker for 50 years ago to join a site today, no issue whatsoever. Exactly the same. We are building exact same way, the way we did 50 years ago. Nothing has changed. We have to build differently. And I think that the fastest growing segment of the construction worker will be factory-made housing, 3D printing. Sweden, 80% of what they do is factory-made. This is the future, and the technology will be there, robots will be there, AI will be there. That's the future, and that will ease the pressure when it comes to supply.
Very good, very good. So we got a question here. We just got it 2 minutes ago. You like that? It says here, why do numbers in media say inflation is coming down when it feels affordability is now at its worst?
That's a very good question. That's something that we have to discuss. We all go to the supermarket. We are all overwhelmed by how expensive food is. You basically have to mortgage your house to buy a cucumber or something. The Bank of Canada does not care. They don't care. Not because of the fact that they are not nice people, they're actually very nice people for central bankers. But because of the fact that it's irrelevant, discuss it with your clients. Inflation is a rate of change. It's not the level of prices. So when we go to the supermarket, we see the level of prices that are very high and will continue to be high and it even will rise. But the rate at which it's rising, it's slowing down. So the rate at which food prices are rising is slowing down, although it's positive, and that's disinflationary as far as the Bank of Canada is concerned. The Bank of Canada cares not about the level, but about the rate of change, and that rate of change is slowing down, and that's why inflation is under control. Unfortunately, it doesn't mean that prices are going down, it means that they are rising more slowly. Very important to distinguish and discuss with clients when you discuss food prices and inflation.
That's actually a really good point. Do you get that? Because we're so used to go up really fast, right? Now they're still going up very, very slowly, so it has ease, and that will turn around. So what's your forecast for recreational properties? That's another great question.
Yeah, listen, I think that the 2025 will be a transition year. It will be a transition year between a slow market to a very strong market. Low interest rates will help, so I'm very positive on that for 2026. 2025 will be a transition year. That's very true for the market as a whole, for the condo market as a whole. Therefore, you have a golden opportunity here to hold your client's hand in difficult times, because the next 6 months will not be great. The spring will be fine, but not great. But interest rates will continue to go down. You are there for them in the difficult times. They will remember you in 2026 when the market will be on fire. Same goes for this.
Next, how does Canada's lack of productivity and lower wages impact affordability?
That's an excellent question. That's an excellent question.
These are really smart people.
Yeah, exactly. That's a very good question. First of all, productivity. I know that only economists can get excited about productivity, but let me ask you a question. How productive is what we are doing now? We don't know, because it's service, and the service is taking over the economy, and it's very difficult to measure productivity in the service sector. The people that put together the productivity numbers in South Canada, believe me, they will not bet their paycheck how accurate the numbers are. It's all guessing. However, in the US they have the same issue. And in the US productivity is rising, our productivity is going down, which means that there is a gap. And this is a major issue. Why? Very complicated. It will take 2 hours to discuss. But one thing, we are a nation of small businesses. The share of small businesses in the economy in Canada is double what you see in the US. And small businesses don't have the time, the money, the energy to invest in R&D. So they are just surviving. Therefore, we are not innovating the way that you see it in the US. They are therefore not growing. Another issue is that, let's assume that you're a small business, you have a wonderful patent, you have a wonderful idea, a great app. Where are you going to market it? In the US. So it's very difficult for us to close the gap. However, I think that if you look at what's happening, and that's extremely important to discuss with clients. You always have to ask yourself to what extent COVID was an event or a condition. And I believe that economically speaking, COVID is a condition. We used to have globalization. Now we have deglobalization. We used to have just-in-time inventories. Now we have just-in-case inventories. We used to have a labor market that was giving. Now it's tight. And now we have all those green initiatives. They're all doing one thing. They're putting downward pressure on profitability, if you think about it. Globalization was good for profit. Just-in-time was good for profit. So companies are facing downward pressure on profitability. Now, you are a CEO of a company. You have two options. One is do nothing. The other is do something. And this something will be to replace labor with capital, which is productivity. And that's why, actually, I'm positive about productivity growth, because companies will have to invest in order to survive. And when you invest, your productivity goes up. Why is it related to you? Because when you have productivity rising, wages can rise without inflation. You go to the dot-com revolution in the 90s. Wages went up by 5, 6, 7%, inflation didn't. Why? Because if I give you a 10% increase in wages and you're 10% more productive, that's not inflationary. So productivity is bullish for your business because people can get a huge increase in their wage, afford more housing without inflation, without the Bank of Canada raising interest rates. That's why productivity, although nobody cares about, is so important and directly linked to your business because it impacts standard of living and income directly.
Very good. Because, you know, everything he was saying, I could have told you. Okay, so just, we got two quick questions here. So, what would need to happen for deflation next year?
Yeah, I think that we are already in a disinflationary period. Inflation is price go down, is limited by the fact that the US is issuing a lot of debt, and therefore their rates are going up. So that's one way to explain directly to your clients how the election results impact you. And under Trump, that will be more because the budget deficit will rise by much more. So that's one thing. The other is, which will impact Canada as well, is trade. If you want to understand what Trump wants to do, there is a book out there called No Such Thing as Free Trade. It was written by Rob Lighthammer, who was the trade representative of Trump back then. And they're talking about 60% tariff on China, 20% tariff on Canada, which is significant. And the point that I'm making, assuming that he wins, that he will be barking a lot, but he will not be biting. Because he can't. Let me tell you why. We know that those jobs, first of all, manufacturing jobs are not coming back. Manufacturing jobs in the US went down before NAFTA, after NAFTA. Before China entered the WTO and after. Before Trump, during Trump, and after Trump. It's not about trade, it's about technology. And even so, more so with AI now. So that's one thing. The other is that we know that tariffs do work. When Trump introduced tariff on China back then, their exports to the US went down dramatically. But exports from other countries went up dramatically. I'm talking about Malaysia, Indonesia, India, Mexico, South Korea, Vietnam. So they took all the market share that China lost. Now, China is not stupid. China is saying, listen, how can I get access to the US market through the back door? I invest in all those countries. So they invest and export significantly in those countries, Malaysia, Indonesia, India, Mexico, significantly. So it's a trade policy by proxies. Now, Trump, in order to stop China, it's not enough now to impose tariff on China. You have to impose tariff on all those proxies. Mexico, India. And here, it's very difficult to do because they will retaliate. And what's happening here? 1/3 of US exports are going to those countries that are the proxies. 1/3. Which means that the US manufacturing sector is very dependent on the fastest growing segment of the global economy, which is the consumer of emerging markets. You impose tariff on them, as Trump, you're going to lose your pence. And that's manufacturing, that's your best. He cannot do that. And that's why he will be barking, he will make a lot of noise, but he will not be biting. The way NAFTA 2 is exactly like NAFTA 1, despite all the noise. So there will be a lot of noise, a lot of hoopla, but will not be major changes in trade because you simply cannot afford it, given the reliance of the US on the consumer of emerging markets, which is the fastest growing segment of the global economy.